Good morning, my name is Mohammed Dian and this is my Viva defense for the Digital Banking Risk Management case study. My report examines how digital transformation affects banking risk across four parts, covering three countries, three commercial banks, and three central banks. The countries I chose are UAE, Singapore, and the European Union. The commercial banks are Emirates NBD, DBS Bank, and Deutsche Bank. The central banks are CBUAE, the Monetary Authority of Singapore, and the European Central Bank. I selected these because they represent three distinct regulatory philosophies: innovation led in the UAE, institution first in Singapore, and the protectiveness in the EU, which allows for meaningful comparison. I identified trade finance document verification as a process that remains largely manual across all three banks. A typical letter of credit presentation involves 10 to 20 documents checked by hand, with the ICC reporting a 70% first presentation error rate. I proposed a AI powered smart document verification system combining OCR, NLP, and a Hyperledger blockchain that could reduce processing time from 5 to 7 days under to now under 24 hours and cut operational risk substantially. In part 2, I examined whether cryptocurrency can function as money. My key finding is that it cannot, at least not Bitcoin. Using my Excel data of Bitcoin daily prices from 2020 to 2024, I calculated an annualized volatility of approximately 65.5% using the standard deviation function multiplied by the square root of 365. This is more than double the 25% threshold identified by Bauer, Hong, and Lee in 2018 as the upper limit for monetary stability. Emirates NBD's LiveX app and DBS's digital exchange both allow crypto access, but through carefully separated structures that insulate the bank's balance sheet. Deutsche Bank offers only custody. None of these constitute using cryptocurrency as a conventional medium of exchange. In part 3 is my quantitative analysis. I ran two OLS regressions in Excel on 100 cryptocurrencies across 5 years of daily data, approximately 1,800 observations. My first regression was a simple Kappa model with BTC as a market proxy. The beta came out at negative 0.065 with a p-value of 0.10, not statistically significant at the level 5 at the 5% level. This makes sense because the 100 crypto portfolio includes many altcoins that move independently of Bitcoin. The second regression added 5 event dummies for money laundering and sanction events. My second regression added 5 events for money laundering and sanctions events. The most significant finding was the Iran sanctions breach in March 2024. This produced a positive abnormal return of around 11.2% with a p value of 0.057, which is marginally significant at the 10% level. This is counterintuitive but important. It suggests crypto demand actually increased around that event, possibly because the market participants viewed digital assets as a tool for sanctions circumvention. The Tornado Cash sanction showed a negative abnormal return of 4.6%, which aligns with the direction predicted by Al Makable. Though it was not significant due to the portfolio averaging across 100 coins. In part 4, I compared three CBDCs: China's ECNY, the EU's digital euro, and the UAE's mBridge against three stablecoins: USDC, USDT, and PayPal's PYUSD. My theoretical analysis used chartalism to explain CBDC's money derives due money derives value from state authority. I used credit theory to explain tokenized deposits. They are a bank's promise to pay a distributed ledger. And I used social institution theory for stablecoins, which work because the market collectively believes they are worth $1, not because any law requires it. From Basel III perspective, the most important finding is that under the BIS 2022 rule, unbacked crypto assets attract a risk weight of 1,250%, meaning a bank must hold 12.5 times the equity against crypto position compared to the normal loan. This severely limits institutional this severely limits institutional crypto adoption. CBDCs, by contrast, carry a 0% risk weight as sovereign liabilities make them the most capital efficient form of digital money. To conclude, my central argument is that digital transformation does not eliminate banking risk, it redistributes it. New operational risks from AI and blockchain replaces old manual errors, while legal, reputational, and systematic risk grow as crypto exposures scale up. My empirical results show that enforcement events have asymmetrical effects. Sanctions can paradoxically increase crypto demand rather than suppress it. This has direct implications for compliance officers managing AML exposure under WADA, MiCA, and BIS lines. Again, this has a direct implication for bank compliance officers managing AML exposure under VARA, MiCA, and BIS guidelines. My key recommendation is that BIS should update Pillar 3 disclosure requirements to include mandatory reporting of tokenized assets exposures, and CBDC settlement balances areas currently not captured in the standard framework. Thank you.